Greetings, everybody. It's Thursday, July 17th, 2025. I'm your host, Nick Zaharias. This is a webinar sponsored by the Pasco Hernando County chapters of SCORE. I'm the owner of Capital Access International. We're a commercial lender here based in the Pasco County, Tampa Bay area. More kind of a boutique experienced lender, meaning that we both direct lend, so we initiate loans. We also act as agents, as syndicators. I'll go over to what those things mean. Today, we're going to be talking a little bit about alternative lending options for small business owners. That's my specialty. I deal with business owners every single day and try to secure optimal funding for their business plans, whether it's the purchase of equipment or for whatever it is that they need. This webinar was started because of actually a lot of these conversations that I've had with business owners, because as I speak with them, I understand that there might be a lack of understanding sometimes on the basic fundamentals about what they're going to see or what they're going to encounter when they go out looking for capital. So that's what this webinar is about. I'm hopefully going to provide some information and some tips that will be valuable to you as business owners. And so let's move forward. I won't waste a lot of your time because today is a working day, so let's get to it. Alternative lending, like I said, is the subject matter today. Why do we call it alternative? Obviously is because it's an alternative to the traditional lendings and the conventional lendings that you may have seen out there. It's important to understand why this market has developed. It's developed and evolved organically out of a need. And the need has come primarily because of traditional lending is closed to a lot of businesses, so they need to find alternatives. I'm gonna go over a couple of the points that we'll be going over today. So we're going to talk a little bit about why alternative lending matters. I just covered that a little bit. Alternative lending matters because it's needed, obviously. I'm going to go over a couple of the key lending options. I'm not going to focus on each and every one of them because there are quite a few. A lot of them are accessible without having to go through agencies. They're accessible online. Others are, you really do need an expert. You need someone to be able to help guide you. We're also going to talk about choosing the right option. This is key because just like with any service that you need for your business, you also have to find the one that's the right fit for you. I'm going to talk about a few case studies. I have a lot of experience funding companies, and because I didn't want to focus too much time on case studies as a singular slide, I was just going to interject them as I'm explaining different products. So perhaps it'll help maybe understand in practical terms, how this was used or in what cases this was used. And then, of course, at the end, I'll open it up for Q&A. And hopefully I'll be able to have enough time to answer any questions. This information, everything that I'm saying today, everything that you're seeing on the screen will be available to you, including my own contact information. So if you need any clarifications beyond what's covered today, feel free to contact me. So business owners don't really need to be explained to them why access to capital is crucial. My company's name is Capital Access for a reason. It's because I realized that it's access to capital that's primarily missing, especially in the first 2 to 5 years worth of a company's evolution. As you can see in the screen here, the percentage of requests made for working capital by small businesses are widely rejected. 8 out of 10 of them. This is one of the main reasons why businesses go out of businesses. The mortality rate for small business is high. 82% of small businesses fail due to cash flow issues, according to many statistics. I would say, and I put this in parentheses, it's mostly due to lack of access to affordable capital. Businesses start with whatever founder's money is started with, or sometimes they're started with equity or investors. But at some point, you're going to need some financing to grow, whether it's for equipment, to purchase, to hire, to move. There's just a variety of things that financing is going to be a part of. So it's good to know what the actual, and get a reality check as to what is you find in the marketplace. Excuse me. So Small, medium businesses, have used alternative financing, obviously because they need it, but they did so mostly to seize growth opportunities. This is alternative lending isn't used by business owners who are desperate. It's just that they aren't able to find the funding that they need to grow from traditional sources. So let's go into that. What are the traditional sources? Traditional bank lending for any businesses that have actually um, started to look for money or try to apply for a loan. You'll notice that traditional banks tend to have long approval times. They can take 30 to 180 days. I don't think I've ever seen a 30-day loan done except for, known clients. Banks don't have a lot of incentive, apparently, to hold commercial loans, so they make the qualification standards quite rigid. Bank lenders sometimes require as much as 3 years of continuous profitability. As a business owner, it's great to have profitability. Sometimes business owners, when they have a really good year, will actually try to make moves, accounting moves that would actually lower that profitability so they can lower their tax burden. That's just good planning. I don't think that should be penalized, but sometimes it is. So you want to show profitability, but you want to keep the profitability just high enough so that you're not overly burdened with taxes, assuming that you have enough in accounting ability to be able to reduce that obligation. So the qualification standards are high. And then there's another thing also because there's not a lot of incentive on the banks to hold commercial loans, they have like a one size fits all approach. So, banks will be more willing to extend loans for people that already have, say, checking accounts with them. They'll also ask you to include other services that their bank or their affiliates might provide, like an insurance policy. Maybe they'll want your personal accounts. Maybe they'll want your home mortgage. Maybe they'll want your merchant processing accounts. So they want to package this together because frankly, the commercial loan side, a la carte, just on its own, isn't that much of a profit center for banks. So we go to the alternative, and I'm going to go over a couple of what those are. It's not necessarily a matter of being better or worse or smarter or dumber. It's just a matter of basically covering your need. And the alternative lending market exists because of the need. And I'm just going to go over a couple of these. I'm going to focus in on a couple, which are the ones that I most predominantly see. The general list starts with term loans and LOC. Term loans are monthly payment loans, lump sum proceeds. Some of them are secured, some of them are unsecured. For working capital, they tend to be unsecured, and they go out as long as 10 years. Some of them are through the SBA, some of them are through private lenders. LOC means line of credit or business line of credit. That is an amount that you actually get given, and then you can take it out as you move forward. I'll also go over peer-to-peer lending. That's, as the name suggests, you're basically dealing with other businesses and other syndicators. So you're basically playing matchmaker. The need is here, the money is over here, and a forum or platform gets in between and tries to make those matches. Microloans, that's for smaller artisan type companies. I won't go into too much detail there, but I'll share a few ideas for you. Equipment financing, every business is going to have to deal with that. Invoice factoring is a way for businesses that have accounts receivable. So if you're a business that's doing business with other businesses and you've got invoices out that have 30-day payment terms, 60-day or 90-day payment terms, you can actually access, or I would say front load, that amount of money instead of waiting for it. Obviously, you're going to pay for that at a discount, and that's where they use the term factor rates. I'll go into that when we hit that slide. Merchant cash advance, I would say that this is the primary source of working capital for startup businesses that don't have access to regular bank loans. I'll go into a little bit more detail of that when we hit that slide. And then hard money loans. I didn't really do a slide on hard money loans today because they're specialized. And they're also a hybrid in between commercial and alternative lenders. That is, they're issued by banks, but they're actually syndicated or participated in by private lenders. The difference between hard money loans and, say, a regular term loan is, first of all, they're always collateralized with commercial property. Second of all, they look and smell a lot the same in the term. So there's monthly payments, there's shorter terms between 2 to 3 years. I would say the main difference is they're more malleable in the sense that they can be adjusted to the needs. One example I can remember is we financed through a hard money loan the purchase and remodeling of a building, which was a medical office building. The medical office building needed to be converted into a specialized hand surgery clinic. So there was two aspects, the purchase of the property and the conversion, which all included money. So we put together a single loan, and the first year had no payments. It was a 3-year loan, but for the first year there were no payments, so that all of the proceeds that had been initially issued could be used for the remodeling and for the conversion. That's just an example. All right, let's move forward on some of these on details then. Online term loans and LOC. LOC, again, I remind you, is line of credit. Term loans and line of credit are issued by a lot of online vendors, as well as you can also get those through offices like myself, through boutique lenders. So we can also provide Bluevine and Fundbox LOCs, as well as other issuers. Again, you're not going to talk to a lot of human beings here. This is a very, very electronic online experience. So you go in, you make your applications, you get approved. Assuming everything is done, they ask for specific documents. You send them back and forth, you get approved, and you get sent the money. They're very, very efficient. They just have, a very high decline rate. And so, anyone who can access, these fundings will be able to get to them pretty quickly. There's also private lender term loans. These differ from SBA loans just in the sense that they're a little bit shorter term. So instead of having the SBA stamp on them, SBA tends to go out as much as 10 years. Private lender term loans will go out as much as 5 years. So they tend to be between 2 to 3 years. I would say that's the main difference. These products have higher rates. There's strict a little bit qualifications. When I say higher rates, I mean higher rates than the absolute prime rate that you would get if you were General Motors walking into the bank. One of the advantages of these products also is that they're very quick. Most term loan type situations are at least 4 weeks to be able to actually see any funding in your account, whereas LOC and some of the other products, can actually get funded within a few days. Again, these have a pretty high decline rate, so you're going to want to keep an eye on that. That is, it's good to check and see if you qualify for these. But if you don't, then you need to move on quickly, because if one declines you, then the other ones will also decline you. And if you're making a lot of multiple requests for the same thing to multiple lenders, that's not a good look. Invoice financing factoring. For business to business people, that if you're issuing invoices to businesses and you've got 30 days, 60 days, 90 days, a factor will come in and discount that amount for you and give you the cash right now. The pros are is that doesn't show up as debt on your balance sheet. One of the cons is obviously it reduces the profit, because if you're expecting, say you've got $100,000 in accounts receivable, that's going to be reduced. You're going to get it now, but it's going to be reduced. So basically what you're doing is you're selling your outstanding accounts receivable at a discount. I remember there was an organization called J.G. Wentworth, had a lot of advertisements on television. They used to be ubiquitous. You couldn't miss them, where their tagline, I think, was, it's your money, use it when you need it. So basically what this is a kind of a commercial version of what J.G. Wentworth was doing. They were discounting a guaranteed revenue stream up front and then waiting to collect, and are obviously earning the difference. So this is what an invoice factor would do. It'll give you your money now when you need it, but it'll be at a discount. The only other thing I would add here on invoice factoring is that Lenders, if I do an invoice, I don't do factoring as a primary lender, but the factors that I work with can go to the vendors to whom you have issued these invoices to collect them in the event of default. And that's something that's important to be aware of. So let's move on to the next slide real quick. Equipment financing, at some point, just about every business runs into this. Equipment can be anything. Equipment can be anything from a $500,000 medical imaging piece of equipment to a Ford F-150 for deliveries. Equipment manufacturers, this is a specialized kind of lending. So equipment manufacturers, the companies that actually make this equipment, for a large part, especially for the high-priced pieces of equipment, do tend to have either agreements with lenders, or they may even have a lending arm themselves and actually do the financing themselves. There are specialized equipment lenders that are very, very acute, have acute knowledge about the resale value of specific types of equipment, and they will come in and actually finance equipment for you to help you grow your business. Manufacturing is an area that I've seen equipment financing used a lot, and I should point out something about equipment financing, which may be important for those of you considering it. Equipment like, for instance, in a granite manufacturer or granite fabricator that's going to be spending almost $1 million for a granite CNC machine, that specialized machine that cuts granite, isn't going to only need the cost of the equipment itself. There are add-ons, software, different specialized parts and bits, training that comes along with it. These are not included in equipment financing contracts. So when an equipment finance or equipment lender finances your, say, CNC machine for your granite fabricator, you might need another $20,000 or $30,000 in addition to what you're being financed just to get it set up, to move it, to set it up, to get it working, to buy the software, or to do whatever upgrades are necessary. So what we do in those situations is we will actually try to combine the equipment financing portion with, say, a short-term facility, either an LLC or a cash advance. In some cases, a term loan might even work, so that you can cover those additional costs without having to hurt your cash flow. Okay, so let's move on to the next slide. Here is crowdfunding. I'm not going to spend a lot of time here. This is not debt. Crowdfunding is equity. I do have a lot of experience in raising equity. I was an investment banker for a few decades. I used to raise money for companies, and essentially that were nothing more than a business plan. So not only did they not have earnings, they didn't even have sales. In some cases, they didn't even have a place to work out of. This was a business plan that needed to be funded and get started. And crowdfunding, that's what it is. It's basically a marrying of the financing needs with those potential investors who would want to participate. Kickstarter, Indiegogo are a few of the platforms you may have seen or heard. If you're going to do that, first of all, you don't need someone like myself. This is something that's done. It's a crowdfunding is kind of, as the name suggests, it's kind of like a do-it-yourself process. That in obviously juxtaposed against investment banking, which is a very managed process. But crowdfunding is good for companies that have a good startup story. The 11-second elevator pitch that you required, or the executive summary that's going to explain to folks, how your company is going to change the world. And if you have that and it's compelling, then I would suggest that crowdfunding, like in a Kickstarter, might be a good way to start. But if you have a compelling story, then finding angel investors, investment capital is also something that you're going to need to do. Let's move forward here. Peer-to-peer lending is, as the name suggests, peers of like, that is borrowers on one end potential lenders on the other end. Some of those lenders could be professionals like myself that have actual funds that need to put to work. Others might just be individuals that have an IRA that they have some cash in and they need to put it to work. The platforms most common that I've seen are Lending Club and Funding Circle. What these do is actually they create a central scrutinizer. That's actually from Frank Zappa song, but it is a central scrutinizer that takes the borrowing requests and underwrites them essentially, and grades them so that when your request, say you go in for a request, and you will get a grade in terms of the risk. This is high risk, medium risk, low risk, whatever, and they'll also propose different terms that investors might want to participate in. If those vessels, empty vessels of offers, are actually filled with actual money, then you can actually consummate loans on these. One thing I would have, I would venture caution on one thing. Peer-to-peer lending, I've heard on a number of occasions, has caused multiple credit check pings on personal credit. So because you have to provide personal information, sometimes that personal information gets spread out in a shotgun style blast. And what happens is that you get multiple pings on your credit without necessarily having consummated loans, and that can drop your credit. I've seen that decimate credit scores, making it even harder to secure financing moving forward. So, all right, let's move a little bit down the line here and keep things moving. Merchant cash advance. This is an important slide. I wanted to dwell a little bit on this because this is the bulk of the loans that small to medium-sized businesses have access to in lieu of or in combination with traditional loans. So just going through the slide parameters real quick. First of all, it's important to understand that merchant cash advances, even though they are erroneously called loans many times, they are not loans. They are pre-purchase agreements. I call them revenue factors, and they're pre-purchase agreements of your future revenue. I'll remind you of the example that we gave you earlier where there was a guaranteed revenue stream that was discounted for in lieu of cash now, the J.G. Wentworth model or the financing, the invoice factoring model. I'm expecting you to get $100,000. This is guaranteed income to me, but if you give me $80,000 right now, I'll sign it over to you. That's the general principle. This is the same principle, only the revenue is your future revenue, meaning that we are purchasing revenue that hasn't occurred yet. Not only is it not guaranteed, there's no way to know that it's actually going to happen. If you run a business with $50,000 a month in monthly revenue, you assume that next month and the month after that and the following month after that, it will be the same. So do we. That's why we do this business. So we're actually purchasing the revenue that you will make in the coming months. These have a lower credit threshold. So business owners that have been declined at traditional banks due to maybe a lower credit score can actually get offers from merchant cash advances. In our particular underwriting threshold, we have a 550 FICO score or higher. This is, by the way, when I say credit threshold, I'm speaking about personal credit of the majority owner of the business. Personal credit is important. A lot of business owners that I've spoken with have a different viewpoint. They seem to like to delineate between their own personal credit and the credit of their business. You are your business to us as lenders. Without you, in most cases, especially for younger businesses, there is no business, or unless there's a machine that's basically producing all the income. So how an owner of a business manages their credit is every bit as important, if not more important, than what the business payment history is actually. Merchant cash advances are a little bit higher in cost. They're shorter term. These are paid back in weekly or daily repayment installments. When I say short term, I mean up to 2 years. When I say high cost, I mean these are done in factor rates. They range between, on the lowest side I've ever seen was a 124, between a 120 and a 124. So that would be a factor rate, and they go up as high as a 125 for very, very high risk situations. And the longest term I've seen on merchant cash advances are 24 months. 18 months, not so often. Most common are between 6 to 12 months. That's the sweet spot. Again, these are factor rates, not APR. So again, when I talk about factor rates, I'm not talking about an annual rate. I'm talking about a discount rate. This is important to understand. I'll give you an example here. This is from a credit card issuer called BrandSource Credit Card. And they just announced their new credit card policy. I'll put this up to the camera. Hopefully you'll be able to see it. It says 34.24%. Okay, this is an APR. You're going to pay 34.24% on the proceeds every year, annually. That's what an APR means. A factor rate means this. If I give you on a merchant cash advance $100,000 and 34% is going to be, let's say it's the same cost of capital to you. This is how it would translate to a merchant cash advance. I would give you $100,000 and I would apply to that a factor rate of 1.34. That is, I would multiply 100,000 by 1.34. So your payback is $134,000. And I would divide that total payback amount by whatever the term is. However many weeks, 6 months, 9 months, 12 months. If it's a 12-month offer, then $134,000 payback after 12 months after receiving proceeds of $100,000, it's the same cost of capital. I hope that's clear. I can go into some more details about how we do those calculations. But that's it, basically. Important to understand, the cost of cash advance money has stayed the same for the last almost 5 or 6 years. We're giving the same offers to people and to merchants that we did 5 years ago at these factor rates: 134, 144, 125. These are the same rates I saw 5 or 6 years ago. There aren't a lot of things that have not changed in the last 5 or 6 years. I can't think of anything else, frankly. The cost of capital, because it's a natural occurring cost of capital, that is naturally demand and naturally supply is being met. This is why it's the actual cost of capital. The interest rates that we saw, especially the ones that we saw most recently, the last years, before the last few years, were not naturally occurring interest rates. They were sponsored interest rates. The fact that we had 0 interest rates for almost 10 years was not a natural occurring event. So I wanted to make that point because it's a lot of times bias and the cognitive dissonance that we all live with, having experienced things and not expecting them to change. It's important to understand that, especially in the last 12 to 24 months, the interest rate environment and everything like that is not changing because of the circumstances. It's changing because the subsidies have been taken away. And so, in merchant cash advance, because this is a naturally occurring, supply and demand market, that's why I believe that has occurred, is that the changes haven't happened. So, merchant cash advance is a quick way that you can actually access future revenue and front load it without actually adding, to your debt. It's important to understand this part because small businesses, when they're, leaving a bank, sometimes they'll get offered a term loan or a line of credit or whatever. When we go in to make those requests, when the underwriting is actually done, and realize that some of the parameters don't qualify, then they might come back with a merchant cash advance offer as an alternative. So be prepared for that. I'm going to move on to the next one, just so you understand that there are a lot of different types of programs, but they all come down to what I just described to you. Again, all this information should become available and will be available to you to access a little bit later if you need to know. Let's move on to the next slide here because I want to get through. This is also important because there have been some recent changes, and I also wanted to cover this for all of our guests today. This is important. The SBA, and you might ask, why is an alternative lender talking about the SBA? SBA is a unique hybrid situation where SBA loans can be accessed and acquired both through traditional banks, that is, you can go into your bank and they'll get you an SBA loan, but you can also come into my office and get an SBA loan. You can also go to, and I've got up here a couple of other ones, Lendistry, BayFirst. There's a lot of other private industries. Why is this important? Different businesses match up with different programs. And so the industries that intermediate between the SBA loans and the businesses that need them are experts at figuring out what type of loan, which type of program the SBA is most compatible with you. That is invaluable. It really is, because you can spend a huge amount of time and a considerable amount of money, barking up the wrong tree, applying for something that's not the right fit. So getting that right to begin with is very important. So like I said, it's a conventional to alternative crossover. That is, you can find SBA loans in the alternative lending market. You can also find them in the conventional lending market. There's been some changes, and these changes are recent, and I wanted to go over a few of them very, very quickly. It used to be that $500,000 was the quickest amount of working capital I could get for businesses through the SBA. That amount has changed to $350,000. There's been a few other changes that I wanted to go over. Like I said, these changes were made as of June 1st. So I've actually only had one loan close, since the new changes. It wasn't really affected because it was already in the queue before the changes came into effect. So what are those changes? I wanted to go over those very quickly. Let me just go to that slide. Here we go. I apologize for the small print. This is the only way I could get all of this into one slide, but I don't expect, you're not going to be tested on this later. I don't expect you to remember all of this. I just wanted to go over a few key points here for any business owners that might be thinking about accessing capital either through the alternative markets, cash advances, term loans, lines of credit, or SBA. It's important to understand that the SBA now this is the new filter, and I was just going to go over this real quick to make sure that you guys understand it, and hopefully it'll help you to plan better. So standard operating procedure, SOP. Under the new SOP, all owners, guarantors, and key employees for the business must be U.S. citizens, nationals, or lawful permanent residents, meaning they must have a green card. This already existed, but because of the political climate that we're in right now, this is very, very key. And it just has to be paid attention to more than it was paid attention to in the previous years when we were doing these type of loans. The other main change, and I want to point this out, is that anyone who is not a U.S. citizen, that is ineligible, all right, cannot have held any roles in the business for the previous 6 months prior to making the request. That's new. Also, there's something called the SBSS score and access to funds. What is the SBSS score? I think I can help here with that a little bit. FICO is your personal score. SBSS score is the business's score. It goes from 0 to 300. The SBA used to require 155 minimum. Now they require 165 minimum. The best way to acquire an SBSS score is to first get a Dun & Bradstreet number. So once your business is listed with the Dun & Bradstreet, then that process starts. The SBSS score is actually calculated by the SBA, but we can also do that ahead of time to be able to filter these. So let's move out of this. So the 155 to 165, so a little bit higher on the business score. The other significant updates were the 350 instead of 500,000. So because you can reapply for an SBA loan, after a certain time, 90 days, some merchants, instead of going for a larger loan, say $1 million, $1.5 million, they might actually apply for a 350 working capital loan, get it closed, and then in 90 days reapply for another one, and they can do that too. Sometimes that works, sometimes it doesn't. It depends on the situation. Again, a boutique experience is necessary even in the SBA because they change the parameters a lot. And let's face it, businesses are all different. So it's important to understand where things click and where they don't click, and basically not put effort into things that aren't going to produce good results. This is really key because if you go back to uh, uh, the merchant cash advance slide that I was talking about, it's like you have to calculate things that are going to affect your timing. So if for example, here on the SBA, like we were talking about this, if for example, that it's going to take 3 to 4 weeks to get funded, but also know that in 2 weeks you're going to need some funding, you can plan for that. You can mix match, these products in a way that fits your business needs. And it's important to understand, number one, what your needs are to begin with, and to be able to analyze those needs and also to truly evaluate yourself. This is the job I spend most of my time with on the phone with customers, is trying to evaluate what it is you need, whether or not you qualify to get that much, and assuming that you do, what it's going to cost. And that's really the planning that needs to go into this. So okay, how to choose the right option. This is a slide I wanted to, I didn't go into too many details on all of the options. I spent a little bit more time on the merchant cash advance and on the SBA, on the term loans. I'm more than happy to spend any time with any of the participants that are here with us today to clarify anything further. But I also wanted to give you guys, if there was one thing I'd like to have you do when you leave this webinar, is to have a mental checklist about what it is that you need to be thinking about when you're seeking capital. So let's go over those things briefly, and hopefully this will be something that'll be helpful to you. How much do you need? One of the first questions that comes out of my mouth. How much are you looking for? First of all, it's important to make a good evaluation of what it is that you need. So if you're looking for a piece of equipment and it's $100,000, you might also want to consider other things that might be needed. So you might want to be requesting not quite right at the number 100,000. You might want to be looking for 120,000. So making that calculation is important. Qualifying for what you need is a calculation most business owners can make. I'll give you an example. On merchant cash advance, the cap, that is the amount of proceeds that is most likely to be offered, is going to be the average revenue that your company has shown for the previous 90 days. Sometimes it's a little bit longer than that, 3 to 6 months. So whatever your monthly revenue averages out to for the previous 3 to 6 months, that's the amount, that's the cap. So if you're a company doing $50,000 a month on average revenue, and you need a $150,000 loan for whatever purpose, you're not going to get that amount from a merchant cash advance. You're more likely to get that amount with another facility, like a term loan. Okay, so that's why determining the size that you have and what you actually qualify for, okay, is very, very, very key. Credit score, it's good for you to know what your credit score is, both personal and what your SBSS score is. So it's good to keep track. Your personal and your business credit scores are joined at the hip. There, there is no difference from a lender's perspective between the credit quality of the person who runs the company and the company as a standalone entity. I'm just putting that out there because it's important to understand. So keeping an eye on your credit score is very important. 650 and above is the level of personal FICO score for to have access to what we call the higher tier lending products. Higher tier lending products are the ones that have the longer terms, the lowest rates, the lowest fees, and are the ones that the fewest applicants get. So keeping an eye on that score is very, very important. And sometimes it's not easy to do. I have made loans for medical professionals whose practices are doing great. Revenues very, very high. Come to find out that the credit check, shows them at sub 600 FICO score because they had $300,000 of student debt that hit their credit really hard when they were first starting out. So it's that alone would make an otherwise very qualified company that could get a very, very good quality term offer, essentially relegated to a much higher risk offer. And so the difference is critical. I can also say that there are organizations, not us, but we do have some people that we've used in the past that can actually move credit scores. Now, I don't want to go into this too much. I have personally seen credit scores, sub 600 credit scores go above 750 in a matter of weeks. There was money involved, there was some payments involved, but I think it involved some direct contact with the agencies, and it worked. We were able to get the loan approved where it wouldn't have been approved due to the low FICO score. So it's critical. I mean, I would say it's critical. Some deals, it's make it or break it. Speed of funding. As a business owner, you don't always get to choose the situations that are going to require you to need money. Sometimes they just come up, whether they're opportunities that happen or whether they're not, whether they're bad events that, tax obligations or damage, to property or to businesses, warehouses, catch fire. There's all kinds of expenses that come up in a business that all of a sudden. So it's not always easy to say, oh, I know I'm going to need this money in 3, 4, 5, 6, 7, 8 weeks or whatever. So I'm going to start my planning now. That's good to do. Doesn't always work that way. So the speed of funding, how quickly you need the money, is a very, very important consideration as to what type of program you're going to be looking for. That is, if you need the money within 30 days, then trying to find say a $1.5 million term loan is, even if everything goes well, you won't get the money in time. So in situations like that, you're going to want to consider combining, say, how much would it cost me to use the short-term money now while I'm applying for and hopefully securing better term financing later. And then sometimes what we do in those situations is bridge, that is, offer short-term higher cost financing now, however, with discounts that pay off early so that when the 6 weeks or 8 weeks that's required to fund the new loan can come in, those can actually dovetail together and save you some dollars. The speed of funding obviously is critical. You're not always able to plan for it, but how quickly you need the money is going to play a very, very significant role into what type of product that you can qualify for and how quickly you're going to get it. Repayment ability. What is this going to cost me as a business owner? How is this going to get repaid? This is what we look for as lenders. How are we going to get repaid? This is important because the repayment ability is going to come into your cash flow calculations and so Um, a recent example, I'll use one here from a Florida-based company, needed $200,000. I was able to offer them a merchant cash advance, an 18-month merchant cash advance with a factor rate of a 129. So 129, if you multiply 129, 1.29, I'm sorry, 1.29 times $200,000, it comes up with $258,000, I believe. Let me just make sure I didn't get that wrong. Okay, so $258,000. $58,000 is this merchant's cost of capital. And the way I explained it to him was that it's going to cost you $58,000 in rent to use my $200,000 for the next 18 months. And the way that you're going to pay me back is the following. I'm going to have you pay me back in weekly installments. So we divide the $258,000 by 78 weeks, which is roughly 18 months. And that comes out to $3,307 per week. So $3,307 per week is what the cost is per week to use my $200,000 for the next 18 months. And then on the last payment, you're paid off, it's over with. This is important because it's like renting money. This is what I explained to the merchant is that it's going to cost you the difference between the principal amount and the overcharge amount, I think was like about $900. That is out of the $3,300 weekly payment, about 900 was actual cost, was actual profit to the lender. Okay. So I said, this is your cost. The rest is your money. The rest is just return of principal. Okay. So you're just paying me back the money I gave you. But this is my profit. This is what I'm charging you to use my $200,000 for the next 18 months. So repayment ability, understanding how this is going to get paid back by your business, why are you using the capital, is critical. And now you might want to ask, why would somebody pay, 29% or 34% or even 50% for money? Well, there's a lot of reasons. If you're a business owner, there could be a million reasons. Another example, Granite Fabricator out of Maryland was making good money importing exotic stone from Brazil. Got a call from their supplier in Brazil that said to them that the company's being bought out, and offered them all of the inventory that they had of the same product that they were buying at 30 cents on the dollar. But they had to buy it all right now because the company was getting bought out. This was an opportunity. 30 cents on the dollar for the exotic stone was roughly about $380,000. We got him a cat. No bank would have been able to get the money to him as quickly as we were able to get it to him. And so the $380,000, he was able to cut a check. Did it cost a lot? Yeah, it cost 39%. But that stone was on a boat. It was 90 days in his shop. And I have no idea what hundreds of percentile of profit was being made on the kitchens that was now being made with this material that he was able to buy at 1/3 on the cost because he was able to access the money quickly. So that's just another example. I think the last one is really critical. It kind of goes to everything else that we're just talking about. You want to talk about the loan size, obviously. You want to be looking at your credit score. You need to know how quickly do you need the money. You also want a picture in your head as to what is this going to look like on my balance sheet as I'm moving forward and making payments on this. And obviously, you have to, and all of these coming together will answer the following question. Is it right for your business right now? So alternative lending products is not a question as to whether or not they're right or wrong or good or bad. It's whether or not they're right for your business right now. And that's just a calculation. It's truly arithmetic. And I think this is if you don't take anything away from today's meeting, please understand that just by having this basic checklist in your head, things are going to get a lot better. Okay, so what lenders actually look for. Monthly revenue trends. We want to see exactly what money's coming in and what's going out. Industry type is important. Roofers are good for us. Restaurants are good for us. Used auto sales are a little bit harder. Truckers are a little bit higher risk. You can still get offers, but they're a little bit more, not quite as not quite as good. We're looking for time in business, so at least 6 months. I like 12 months. Most lenders would want at least a year, if not two, in business. We're also going to take a look at bank statements and cash flow patterns. We want to see how the money's coming in and how the money's going out, and what the and what the cash flow situation is, how the money goes in and out of the company. Once we get that picture, then it helps us as lenders understand how we're going to get repaid. Obviously, credit history is really, really key. I'm going to go on to the next slide right now. Um, Understand your needs before you're borrowing. Read the terms carefully of everything that you get. So if I'm sending you a contract, make sure you read it. You want to choose reputable vendors, obviously with good reviews, people that try to get referrals. Don't be ashamed to ask referrals. I actually enjoy it when people say, hey, send me the name of a few people that can actually tell me what their experience like with you. I welcome that. I have no problem with that at all, and no lender really should. Look, common sense is your best advisor. You got to be aware of the frauds. Unfortunately, our business has quite a few frauds, and it's just one of those things. I can't tell you how many times I've had business owners tell me that uh, they were told that they were approved for a $500,000 term loan with kick-ass terms, but the only way they could access it was if they took this really, really, really bad $10,000 loan to prove themselves. No lender needs you to prove yourself to them. We know how to do that. It's called underwriting, and we understand how to determine whether or not there's a good risk or not. So yes, if they can offer you something good, they'll offer you something good right away. You don't need to prove yourself. Also, beware of people that are telling you that they can get you term loans when in fact it's merchant cash advances. It's good to be honest. Ask them straight up. A lot of these conversations that lenders have with brokers give them misconceptions as to what is actually important to the lenders and what isn't. I get asked all the time, are you a direct lender or a broker? Well, the answer is really a hybrid, because when I make a loan and I initiate a loan and then my company's on the contract, that's a direct lender. But if I have to facilitate a loan through Bluevine and get you a line of credit, well, what does that make me? I guess I'm an agent. So it's important to understand what it is that you're dealing with so that you know what to look for and you know what's right for you. Let me take a look here real quick. I'm going to stop share and just try to catch if I can. I've got Q&A. Hello from Exton, PA. Shout out. Any thoughts about going for a line of credit? Well, yes, obviously lines of credit are something that everyone wants to be able to try to get. Keep in mind that a line of credit is an amount that you receive. This is an amount that you receive, but you don't have to take all of it. You can take 20,000 of a $100,000 line of credit. You're only going to be paying on the amount that you actually use. The problem that I have with lines of credit, and this is important to understand, is that if you get approved for a $100,000 line of credit and you're only using a portion of it, theoretically, you should be able to go back and use, say you take 20, and you want to go back after a month and take another 20. That should be an automatic. You should be able to just write a check. Unfortunately, what I found is that sometimes circumstances change. If there's been some event, some interest rate event or something like that, then it's almost to go back and get the money that you had already been approved. It's almost like you have to go through a whole new approval process, and it's a little cumbersome. So when I tell people to get a line of credit, I say, yes, but if you need $100,000 and you get a $500,000 line of credit, then just understand that if you're going to try to access the difference from what you take right away, you may have to go jump through some hoops. Just be aware of that. Let's see, what was the other question? Is there any specific funding that you recommend for online businesses? Well, because you're an online, but yes, online businesses are, the merchant cash advance is a good one for that. You can get term loans for that. But online businesses, because you're online businesses, I would say that the crowdfunding and the peer-to-peer lending products tend to be very commensurate. Because you're already online. These are mostly online accessible, products. It really depends on the amount that you want. And then, of course, you also want to do what I showed you earlier. That is, if you want to take a look back and kind of look at what the choosing the right thing is. So you're an online business. How much do you need? How much are you doing right now? What's your credit score? How quickly do you need it? Based on the amount of money that's coming in right now, what's your ability to repay? Is it right for your business right now, assuming that all those previous questions are answered? Do you see how I did that? So that's I guess that would be uh that's the answer to that right there. Here, let me which loans would you recommend for purchasing an existing business? James. Okay, James. Leveraged loans, so using the existing business's assets on a hard money loan. It depends. If you're going to be using the purchased business as is, just a turnkey, buying it and just start running it, then use a term loan. Maybe use a cash advance. You need something that you can actually use the proceeds or as much of the proceeds that you can early on. If it's a business that's going to require further investment and time to get online and up and running, well, then you might want to be looking at just leveraging the assets of the actual company, the target, or a term loan. Those are really good too. I'm sorry, I've got another question. Let's see. Uh, I think that referrals are best for marketing. Any thoughts? Referrals are very, very good for marketing. Any good places you can recommend for startup funding? Startup funding is, crowdfunding. So, crowdsource or crowdfunding is a good sign. Angel investors, there's a lot of online forums and so on. You need a good story. And, let me tell you something. If you've got a good story, that's something of value. You just have to be able to understand that you have to get it in front of the right people, because the right people get 1,000 stories a day. So the whole deal is like it is with Hollywood. If you've got a great story, nobody's going to know about it unless it's in front of the right person that can actually make it work. So that would be my advice, is get that story out to the right people. The first people that I would approach would be the people that you do business with, who know you and understand you. Anyway, I'm going to go to the last slide here. Hold on one second. Just to get this share this real quick with the rest of you. I appreciate everybody joining me today. Really, this was fun. Shout out to SCORE for hosting this. I wanted to just make sure that you understand that this slideshow or this slide will be available to everybody participating. You can call me, you can email me. I even have a scan code up here that you can use if you're on your phone right now, and that'll take you to my website. My website also has a blog that I write from time to time, just to kind of give commentary and things about happening in the marketplace. Hopefully this is helpful. Listen, I appreciate it very much. Shout out again to SCORE for hosting this. I hope the rest of you have a wonderful day, and thank you so much for joining me for this webinar. Have a great day and God bless.